Joe, I've got Joanne's thumbs up. I can start. Well, welcome everybody. I'm Jessica. I'm with American Trust Escrow, and I'm so excited to be welcoming our guest speaker today, Elizabeth Burris of Gibraltar 1031 Exchange. Elizabeth is the Chief Executive Officer and lead accommodator, and she brings a wealth of real estate experience to her role. Prior to founding Gibraltar 1031, she managed the sales and marketing divisions of two national accommodators, as well as a settlement services company. In these roles, she led various teams from different organizations, both small and large. Elizabeth brings decades of 1031 exchange knowledge to the group. Personal level, Elizabeth was born and raised in Culver City, California, but also spent time in Houston, Texas, before moving back west to California to complete her undergraduate degree from University of San Diego with an MBA from Pepperdine University Graduate School of Business. She adores food and wine tasting. I can attest to that. Spending time with her family, traveling, sports, and participating in philanthropic events. But Elizabeth's true joy, besides 1031 Exchange, comes from chasing her two children who keep her on her toes. So with that, Elizabeth, I'm going to turn it over to you.
That's amazing. I love it. Thank you so much, Jessica. Thank you guys so much for having me. It's such a pleasure. I'm always available to you guys. I am local. My offices are in Torrance. I'm a South Bay resident. I live in Torrance. I work in Torrance. My office is in Torrance. So I'm always available to you anytime, cell phone, text message. This is kind of a weird, complicated little niche market. So, feel free to utilize me for any questions that your clients might have or any questions you may have. Excuse me. Even if you don't have an exchange going, that's what I'm available for. So I've been doing this, as Jessica mentioned, for decades. Made me feel a little, check my gray hair in the window. But it's true. My father owned a large accommodating service, so I kind of got roped in, very similar to the escrow and real estate world. Like if you have a family member, just go with the flow and just realize that that's what's going to be your destiny. So anyways, please know that I'm always available. I'm also available to come speak to your team, your offices, your own clients. I love speaking, as you're going to be able to see. I have the gift of gab. So I'm always available for you if you ever want to utilize me for, any questions, any presentations, any coffee meetings, anything like that. So my contact information will be up towards the end of the slide. I'm going to do a very brief presentation. We have a 30-minute window here. So I could literally go on and talk about this for hours. Careful what you wish for. So if you have any more specific questions, specific to potentially your needs or your client needs, please feel free to reach out. I'm happy to set up a call. There's no fees for asking questions or anything like that. I'm not an accountant or a lawyer. So feel free to call me anytime. I'm happy to talk offline with you about any 1031 exchange questions. So with that, here we go. Buckle up. What is a 1031 exchange? So it's a section of the Internal Revenue. So if you were to Google, which I hate saying Google because that can send you down to a little rabbit hole, but it's actually literally Internal Revenue Code section 1031. So it's been the tax code for centuries. It's not a new law. It's centuries old. It's not decades old. And it basically allows taxpayers to defer payment of taxes that they would typically owe on the sale of a piece of investment property. By doing a 1031 exchange, you're selling one piece of investment property, purchasing another, and deferring payment of those capital gains taxes. So it's a way to potentially not pay taxes to the government when you have some investment property. So why do one? Investors will potentially owe a lot of taxes, especially around here with such large gains involved on the sale of investment property. So by doing the 1031 exchange, you're able to defer majority, if not all, tax liability on that 1031, I'm sorry, on that investment property. And therefore you have more equity, more cash on hand to reinvest into potentially a larger piece of property. Maybe you want to diversify and do multiple smaller properties. Maybe you want to completely change your asset class. These are all great opportunities when utilizing a 1031 exchange. All right, so in order to not have to pay those taxes on 1031 exchanges, I'm sorry, on the sale of investment property, there's some rules. And these rules are kind of the caveat to this great little section in the tax code. These rules have to all be met in order to defer payment of all those capital gains and have a successful, complete 1031 exchange. So these rules are the types of properties that you exchange or you sell, what funds have to be reinvested, is it the same taxpayer ID selling and buying, and then timelines. And timelines tend to be the stickiest, but we're going to go through them one by one. All right, qualified use. What type of property qualifies for a 1031 exchange? The entire tax code is literally written around the word intent. You have to have the intent to hold for investment or income purposes. So how do you prove intent, right? So that's kind of the common question I get. So all the property that you sell in an exchange, all property that you purchase in exchange must be held for rental, investment income, or used in your trade or business to qualify. The taxpayer must be able to demonstrate that they had the intent to hold. So a lot of questions are, how long do I have to hold to prove that intent? It's actually not clearly defined in the tax code. There's been some case studies and some case examples that have been applied throughout the years that this has been utilized. But in the actual tax code, it's not spelled out in black and white as far as how long you have to hold the property. It all comes down to the investor's intent. All right. And then what type of property can qualify for a 1031 exchange? A lot of, misconceived, like a lot of misunderstood information about 1031 exchanges is the type of property has to be what they call like kind. Like kind does not mean a house in Torrance in exchange for a house in Torrance, or a duplex in Santa Monica in exchange for a duplex in Santa Monica. You can actually utilize this great tool to diversify the type of property that you have and the location. This is a federal tax code, so it's anywhere within the US in exchange for anywhere within the US. You can sell a vacant land in California and purchase 3 single-family residences in 3 different states. You can sell 2 apartment buildings in Florida and purchase a single-family resident in California. That seems like it would probably be a similar exchange for finance purposes. Anyway, so these are just examples of types of properties that you can exchange in your 1031 exchange, and it does not have to be at the same asset class or the same asset class. You can go from commercial to residential, residential to commercial, and then different types of properties as well. Again, it has to just qualify as you had the intent to hold for investment or income purposes. Some things that would not be considered like kind is you can't exchange in and out of a membership. So if an LLC or a partnership owned a piece of property, you can't exchange into that membership or into that LLC. The LLC itself can do an exchange. Again, that goes back to that same taxpayer ID. The LLC can sell and the LLC can purchase, and those multi-member LLCs can utilize an exchange, but you can't exchange in and out of the partnership. That's like a security, so that would not be allowable. Another non-like kind would be your primary residence or primarily held for personal use, vacation homes. Those would be some quick examples. A property that you purchase to quickly flip tends to not qualify for 1031 exchange. So those are some high-level examples of like kind and non-like kind 1031 exchange properties. All right, this is tends to be the most confusing aspect of the 1031 exchange, which is what funds have to be reinvested in order to defer payment of your capital gains taxes. You have to, in order to do a full exchange, you have to reinvest equal or greater of your net selling price, as well as all of your net cash or equity. So let's break that down. If you sell a piece of property for $1.1 million, after closing costs, you're potentially looking at approximately $1 million net. So that net selling price after closing, after allowable expenses, as they call it, qualifying expenses, you have to reinvest that net amount, which in this example would be $1 million, as well as all the net cash. So if of that $1.1 million sale, you had a $350,000 loan, that means that you have $750,000 of equity or cash. You have to reinvest the net cash as well as that net selling price. So you purchase for $1 million or more, and you reinvest that full 750. If you pull out either of those numbers, whatever is not reinvested is considered boot, which is taxable. In the exchange world, the word boot is a 4-letter word, both figuratively and actually. So we don't love that word. It means that you're going to be paying taxes on whatever is not reinvested. We call that boot, which is, again, taxable. So again, net selling price and all the net equity or the net cash. If you were to not get another loan on that replacement property, if you decided you just wanted to go in all cash, that is totally fine. You can replace debt with cash, but you cannot replace cash with debt. Let me repeat that. You can replace debt with cash. You cannot replace cash with debt. So what that means is you wanted to pull some cash out. Let's say you wanted to like go on a family cruise and do some home improvements on your primary residence. So you decided that you were only going to reinvest $500,000 into that replacement property, but you still purchased for 1.25. So you reinvested that net selling price, but you pulled out some of that equity and didn't reinvest that net equity. You'll be taxed on that amount that you did not reinvest. So you'll still be taxed on that $250,000 that was not reinvested. So that tends to be a little bit confusing. That's actually called mortgage boot is what we call it. And so again, 4-letter word, we try to stay away from it and defer all payment of taxes. All right. This tends to be the area of the 1031 exchange code that people dislike the most. It's the timelines. So you have what we call exchange timelines. These are set timelines that are non-negotiable. So both these timelines, the 45 days and the 180 days, start on the day that you close escrow on your relinquished property. So the day escrow closes on the sale of your investment property is when the timelines begins. You have 45 calendar days, that means inclusive of weekends and holidays, to identify any potential replacement property. So that's 45 calendar days. So if that 45th day lands on a Saturday, on Christmas, on your birthday, on a day you're on a cruise, there's no extension. You don't get into the following business day. This basically is simply done by sending in an ID form, which I'll get to on my next slide. But this has to get done by midnight on your 45th day. You have 180 calendar days to complete the 1031 exchange. So that 45 days and the 180 days run concurrently. So it's not 45 plus 180, it's 180 and the first 45 days are the identification period. So you have 180 calendar days to complete the entire exchange process. That means from the day that you close escrow on your relinquished property, you have 180 days to close escrow on any potential properties that you identify during the first 45 days. That's the entire exchange timeline. Again, with the small exception of a nationally declared or locally declared emergency by government, there's no extensions on these timelines. And again, calendar days, it's irrelevant if the recording office is open or closed. A little caveat I have on the bottom, since I have a quick minute, I'm going to mention it, is if you start an exchange, let's say in November, you have 180 days or the day your taxes are due. So if you still need to complete the remainder of your exchange, you haven't quite closed on those properties that you identified during the first 45 days, you have to file an extension prior to, so that you have that full 180 days to complete the exchange process. So if you were to do an exchange late in the year and your 180th day was going to be after that April 15 or when your taxes are due timeline, you're going to want to file an extension in order to give yourself the full amount of time to complete the 1031 exchange process. Small caveat, I can get that, into more details later, but I always like to mention that it's an important tool. Okay, I keep mentioning that 45-day timeline. There's 3 different ways to identify to the QI, myself, Gibraltar 1031, which properties you have intention to purchase. There's the 3 property rule, the 200% rule, and if you can't comply with either of these 2 rules, then there's the 95% exemption, excuse me. So most people utilize this 3 property rule. This basically says that you can identify up to 3 properties regardless of their fair market value. So you sell that property for $1 million, you can identify 3 properties regardless of how much they're for sale for. So this places the emphasis on how many properties you can identify within that 45 days. You do not have to purchase everything you identify, but you only can purchase something that you do identify. So it's not, you don't have to identify, you have to identify what you're going to purchase, but you can identify stuff that you don't actually end up purchasing. So the 3 property rule, again, places the emphasis on how many properties. The 200% rule places emphasis on the dollar amount that you identify. So this would maybe be a great possibility for somebody who's selling in California and purchasing maybe in Missouri or Tennessee. Well, that's getting expensive, but places where like you can buy a lot more property for a lot less money. So this would be places the emphasis. You can identify 4 or more properties that their aggregate value does not exceed 200% of your net selling price. So if you sell for $1 million, you can identify 4 or more properties altogether totaling $2 million. So, you know, potentially 4 smaller pieces of property that maybe are $500,000 each, for example. So this places the emphasis on how the dollar amount that you identify. And then the final option is what we call the 95% exemption. This basically says that if you can identify more than 3 properties for any dollar amount, so this would be 4 or more properties for any dollar amount, but you have to actually close on 95% of the value that you identify. So this would really lock you into purchasing 95% of what you identify. So this tends to happen when it's like a waterfall effect or a domino effect, where if you're going to close on one property, you're going to close on all of them, maybe a subdivision or, you know, if a multi-unit thing that happens to be separate APNs. That's kind of where you see this exemption. This is utilized in maybe 3% of all 1031 exchanges across that are ever done. It's very technical and tends to be utilized with, you know, maybe a DST or something that's a little bit more planned out. So anyways, either way, within the first 45 days, you have until midnight on the 45th day to identify using one of these types of rules. Our identification form spells out these different rules, and you'll know exactly how to identify. And again, if you ever have questions, you give us a call. All right, and then finally, this is just a quick step-by-step guide as to kind of how to like utilize a 1031 exchange, you know, where to start, when to get started, etc. So step 1, you start the exchange. I generally love to get involved with my clients as soon as they're even thinking about selling an investment property. It's, you know, always important to check through things like the vesting, how do you hold title, who's on title, who are you going to utilize to sell the property, or who's your clients going to utilize, and just make sure they've really thought through the various obstacles that we can tend to see that we can hopefully identify and clarify prior to the start of exchange. I do not have to get, or the QI does not have to get involved until prior to the closing of escrow. So I always say, as soon as you open escrow, your QI should be your second call. So we like to get involved even prior to, but at
You just muted yourself, Elizabeth.
Lizzie, you're muted.
I
There
did
you
not
go.
mute
There you
myself. I got something in my ear saying host muted you. And I said, oh, I'm cut off. Okay, great. Anyway, sorry. So as soon as you open escrow, give the QI a call. Step 2, as I say, list the property. That sometimes is step 1, but step 2, you guys list the property and hopefully open escrow quite quickly. We prepare the exchange documentation in conjunction with your escrow company. So as I was telling Rick earlier, I'm currently doing 1031 exchange with ATE, Jessica's escrow company, and we started the exchange process right when escrow was opened. I worked with their EO, super seamlessly, super easily, provided all the documentation that was necessary with the client and made sure the client had all their questions and answers to make sure that they were fully aware of like how this process was going to go. We close on the relinquished property. Close of escrow happens pretty like similar to if you weren't doing a 1031 exchange. Kind of the caveat is we have a little extra legal documentation that has to get signed prior to the close of escrow, and that at the close of escrow, funds actually get wired to the QI. We have to safely hold the funds during the exchange process. So from the time that you sell your relinquished property, then we hold the funds until the time you close on your replacement property. So we would send the EMD potentially to your replacement property. We can provide proof of funds. We're holding those funds for the exchanger during that 1031 exchange process. 3 of our kind of key jobs as a QI is number 1, explaining the exchange process to you thoroughly and answering all questions, being an additional resource for you. Number 2, safeguarding and safely holding the funds during the exchange process. The IRS stipulates that the exchanger cannot have constructive receipt of the funds during the 1031 exchange process, or else that would be taxable. And then number 3, the legal documentation showcasing to the IRS that they have entered into and completed a successful 1031 exchange. So we provide the documentation, we hold the funds, and we provide you with all the Q&A that you potentially have. Okay, and then at the close of the relinquished property, you're going to hopefully be starting to identify your replacement property within that first 45 days, and then ultimately closing on the replacement property within the 180 days. A quick thing I wanted to mention when we were talking about what funds get reinvested. If you choose to take out a little bit of money, you sell for $1 million, you want to buy for $900,000, and you want to take out that $100,000 to do, like I mentioned, go on a family cruise, pay some taxes, take your kids to prom, like whatever the case may be, you can still do what's called a partial exchange, totally viable option, and you'll just pay taxes on whatever funds are not reinvested. So that's what we call a partial exchange, and it's totally no problem. The other thing I realized that I kind of skipped through in my effort to be on time is the tax entity. As I mentioned, the IRS unfortunately does not know you by your beautiful given name that I'm sure is gorgeous. It knows you as a number. So it has to be the same taxpayer ID that sells in the exchange, has to be the same taxpayer ID that purchases. What this means is if you own the property as Elizabeth Burrows, a single woman, I have to buy the property as that same taxpayer ID. So I could have a single member LLC because that's a pass-through entity, but it's the same taxpayer ID that sells, the same taxpayer ID that purchases. What I couldn't do is sell in my own taxpayer ID and then purchase in a multi-member LLC. That's a completely different taxpayer ID. So pass-through entities that kind of wouldn't apply here would be a single member LLC, a trust, husband and wife is another kind of situation we can work through. So those are all considered same taxpayer ID. But if you start changing entities or trying to do a drop and swap, that's a different ballgame. All right, so with that said, here is my contact information. Please feel free to write down my cell phone. Please, I'm all about my cell phone. Call me, text me, email me anytime if I can be of any service to you. Always happy to ask. There's no dumb questions. It's a very weird, funky, complicated little law that I try to make as uncomplicated as possible. So, you know, please utilize me for any questions you may have anytime. That's what I'm available for. So with that, I think I did okay on timing, I hope.
Thank you so much. This was fantastic.
Oh,
Yeah, it was great. And I
you're the
love that you
best.
offered your personal info too, because that helps everyone, I think, with direct questions that might be particular to a unique situation. So thank you.
Of course, my pleasure. Again, that's my direct line. It's been my cell phone for forever. So feel free to text me directly and I'm happy to help, you know, and it can be also, I do have young babies, but you can text me, you know, I know it's after hours, sometimes weekends. I'm always working, workaholic, sadly.
Yeah, and from
Unfortunately.
personal experience, I've known Elizabeth for many years, and she is a workaholic and will always be there for you.
Thank you
No,
very much for joining us today, Elizabeth. Really appreciate your time
Thank you,
and
Jess.
being a resource for us. Thank you.
thank you. Thank you. My absolute pleasure. This was an honor and love to chat again anytime. I mean, does anyone have any quick questions, or you can call me afterwards, offline, whatever. I just want to make sure it was available to you. I know I kind of raced through that really quick. So
Good overview. I don't see any questions.
Question.
If there aren't any questions, that means you were really thorough.
yes, it's my coffee, not the fact that my internet went out about 20 minutes before this
Oh,
presentation.
there was a question, Rick, can we get the slides? That's a Rick
Sure.
question.
Absolutely.
Okay. So what's the best, well, we'll figure that out with Rick. I guess you send it to him and he can send it out, or we can send it out.
Yes, my pleasure. You can always reach out to me as well, and I can send it directly to you as well.
Cool.
My website, I just realized is not on here, which is gb1031.com, is also a great resource. It goes in much more detail about the 1031 exchange process. So that's another great resource for you. So I just realized it's not on this slide. Got to fix that. But it's the last bit of my email. So gb1031.com is the website. And then my email is Elizabeth Harris Burrows, ehb@gb1031.com.
Well, thank you. And thank you guys all for joining us
you
today.
so
Really
much.
appreciate it.
Thank you. It was an absolute honor, and I really appreciate all of you guys and hope to talk to you soon.
Have a good day, everybody.
Thanks,
Bye.
Dustin. You
Guys.
too.
Bye.
Thanks,
Bye,
Adriana.
Jessica.
Bye. Thank you.
Bye,
Hi,
Adriana.
Tracy. Hi, Marcy. I'm like, people's names are like coming through. So I'm like, yay, yay.